It looks like we're live here. Bear with me. I am not very technology savvy. So, and this system, StreamYard, is new to us, but super exciting because we can also live stream it on Facebook and some other social media. So, welcome, Jamie. We've got Jamie A. Medris the third here from Colorado. So official.
Thank you. And thank you for having me.
Yeah. Thanks for being here. We are trying to make these webinars a little more exciting and interactive and get out of the norm of having a PowerPoint and listening to me talk for an hour. So when we started talking about having this webinar this month, we had considered having a guest attend. And so there was nobody better than to have but Jamie. He's had quite the journey into the alternative investment world. And I was lucky enough to be part of it, and we've become very good friends. And I'm excited to have you because I think the one thing I love about you is you're just very transparent. You're not going to just tell everybody what they want to hear about your journey to alternative investments, but give them the good, bad, and the ugly. So welcome. Maybe you can just give a little bit of background about who you are, and we can kind of dive in. I've got a lot of really good questions, and I want people to hear your feedback.
Sure. So I graduated at Arizona State University and actually graduated on a Tuesday and started working in commercial real estate on a Thursday. 27 years later, I decided to make a change, and it was time to focus on my family. I spent 27 years with a national real estate company selling retail properties around the country. When I decided that it was time to make a change, I had a team of 20, and I had done everything I had set out to do in the business. So I was ready, and time to be a dad and a husband, and everything that I wanted to be my whole life. So after 27 years, I made the change and wasn't sure what I was going to do with my life, and got into doing some consulting on the commercial real estate side. And still, I had still too much time on my hands, and I had been talking to a friend, and he had said, and I'm probably getting ahead of your questions.
No, it's good.
Um,
I wanted you to
uh,
touch on this.
so I didn't know what I was going to do with my life. I was always just so used to closing deals, the thrill of it, the making of the money, and I'm like, I'm not a golfer. I have a bad back, and I really don't have any hobbies. So I was talking to a friend. I'm like, yeah, I just don't know what to do with my life. And he said, you know what? A buddy of mine just got into he sold his book of business and pharmaceuticals, and he's doing something with deeds of trust and notes. Why don't you give him a call? So I called him. We sat down, and he told me what he was doing. And I'm like, well, that's easy. I've done that my whole life. And I said, well, how do you get started? And he said, hey, I'm going to give you three names, three companies, and from there you'll figure it out. And one of them was Heather, and the other two I wish I would have thrown in the garbage, but that was a big learning experience. And next thing you know, I think that was October 2021 when I bought my first note. So it's hard to believe it's been 4 years now.
It seems longer.
Yeah, it does.
It's funny, your story as far as like how you were introduced to alternatives is very similar to a lot of other people's. It's interesting. I've been in the alternative note space probably for 23 years now, 24 close to. And back in the day, I would ask my clients that were buying notes from me, hey, do you have any friends or family that might be interested? And they always were very funny about it because they were very concerned if they let anybody else know about it, there wasn't going to be enough deal flow for them. And so I literally had one client of mine that still buys notes from me. He calls me up one day. I had never talked to him. He said, I know who you are. You don't know who I am. And I'm thinking, oh my gosh, who is this guy? And he said, hey, I'm neighbors with so-and-so. And I've been asking him for years what he does to deploy his capital, and he would never tell me. And he said, but he was out of town and he asked me to check his mail. And back then it was called mailbox money because you sent checks out. There was no direct deposits. People didn't really wire. So we would send these earnings out with a check. And he noticed all these checks in this guy's mailbox, and he tracked me down through the return address and the company name on there. And he said, I want in on this, but he won't tell me about it. So I think it's funny that, a lot of people think, oh, you guys do all this marketing, you're all over social media. I mean, these types of presentations and webinars and more podcast style things are really just to educate people. I don't give financial advice. I'm not a financial advisor. I'm not going to give you tax advice. But, I think the value in having someone like you here, Jamie, is to educate people on the mistakes and maybe some of the wins you've had. I think that's probably one of the best ways to learn is, find somebody, whether it's a friend or a mentor, that you can find out, what their journey was like and how they learned about things. So we're going to talk a little bit about how you transitioned more from traditional stocks and bonds, and you probably still do some of that. I'm not here to get up on a soapbox and convince people to pull all their money out of the stock market. But I do think, you owe it to yourself to educate yourself about the different alternative investments out there. So that's what we're going to talk about today. I would want to ask you to kind of get started. What was it in the traditional investment world that wasn't working for you that actually kind of started your journey down this path? Was there one thing, or was it just an effort to diversify? I'm curious about that a little bit.
Well, when I exited commercial real estate, I thought I was going to buy commercial properties, and I actually had my first deal in escrow, and I had all the money raised. I had a couple $1 million sitting in my bank account, ready to fund the deal. And at the last minute, and the yield on the deal was 5.5%, and it was a deal with a lot of upside. And I remember something came up at the last minute. I could have closed it still, but I'm like, you know what? For that return, it's just not worth it. So that I canceled that escrow, and I had all this money sitting in the account. I gave it back to some of the partners and took my money and said, okay, well, what am I going to do? And what I looked at is diversification. I have my house, I have my commercial real estate, my stock market money. To be honest with you, I have an advisor and I have him do everything. I'm so hands off with that because I don't know it. But as far as real estate, I mean, that's what I've done my whole life. And if I can't figure that out, something's wrong. So it really intrigued me because with stocks, it's you have a piece of paper. There's not a tangible asset. Whereas with the deeds of trust and the notes, you have an asset there. And if something happens, there's something to fall back on. And like through the years, I'd lost so much money in the stock market just doing silly things. And then loaning earnest money to this guy, to that guy, and that was just if it was too good to be true, it was too good to be true. And that's kind of what kind of worried me in the beginning. I'm like, wait, these a 10% yield versus 5%, like this is home run for me. And that's when we talked, and the first advice you gave me, which I wish I would have followed the whole entire time, was don't chase the yield, because that's what I did when I entered this when I started acquiring the notes. I chased the yield, and I just tried to get money out as quickly as possible to start earning as much as possible. And I'll never forget it. I flew up to Utah to meet with this company that I'd been buying notes from, and everything was going great. And the owner of the company turns to me and he says, "You know what? It's not if, it's when." The next day, I probably had 10 deals with them at the time. Four of the 10 started just, imploding. And from there, it just went, things started going sideways. And I said, you know what? I need to regroup here and follow the deals I did with Heather. I never had any issues with. It was when I started getting off of the program and chasing the yield, that's when I started having the issues. And I mean, I've learned a tremendous amount along the way. I've been through the cycles on these notes, from foreclosure to workout to this, that, to the other. And one of the things that always intrigues me about real estate, that I loved about it, is you never know everything. Every
Yeah.
deal you learn something different. And that's one thing it's, yeah, the money you make is great, but also you're always increasing your knowledge of real estate through all these transactions.
They're just not cookie cutter. And,
Exactly.
it's a conversation I have with our servicing team because, we have, for those of you that don't know, we originate these loans at Central Lending in our funds, and we're going to get a little deeper into really what that looks like and how Jamie's kind of transitioned some of his capital into funds. And so we use these funds to originate our notes. So we lend money out of the fund. They are considered a debt fund, and that's how we make the fund members' earnings, is by things like origination points, interest payments. And so we at Central Lending in our corporate office in Lakeland, we have a team that does what we call servicing of the notes. And so what people don't realize, there's a lot of stuff that goes on behind the curtain. Just because you close the loan, that's like the tip of the iceberg. That's the beginning of the life cycle of the loan. And it can go one of about 20 different ways. Our ideal solution would be that they make their payments and they pay Central Lending off, and everybody makes money. They make money when they sell the property. We make money because they make their interest payments. But there's a lot of other variables that play into that. Sometimes they have contractors that take off. They don't get the deal done or the project done quick enough. They need an extension. So we have an internal team that actually makes sure people that are making their payments, making sure they're getting their rehab project done, making sure that their insurance is paid, taxes are paid. It is a daily task with these assets. And we do obviously have policies and procedures and workflows. If this happens, do this, but it's not cookie cutter. Like, I can look at one deal one day and the next week we get more information. It's like, nope, actually, let's do this. The goal is that we keep these people paying, they get out of the deal and make some money, and our investors are happy, their capital's returned, whether that's to Jamie because he bought a note or to our fund. So it is a learn every single day. I've been in this 20 years, and every single day I'm like, wow, I haven't heard that one before. It's, the goal is to just keep them cash flowing and paying, get them to pay us off, and everybody's happy. But you have to be prepared. It's not for the light at heart. You have to be able to be. And one of the things that I can say that I appreciate the most about you, Jamie, is your flexibility with borrowers. Some note buyers get very emotional. Well, this guy said he was going to pay this note and he's not paying it, and I don't understand. You are very logical about it. Like, let's figure out a solution and to your credit, like, you've done some pretty amazing things for borrowers that did not hold up their end of the agreement, because at the end of the day, you want your money back. And sometimes, putting the hammer down and forcing them into a corner is not going to get the resolution that you want. So I do think you have to be flexible. We'll talk a little bit more about that. But when you first started getting into this industry in the alternative space, and at first it was just the notes, not the funds, did you have any initial concerns that come to mind that you really were like, wow, this kind of concerns me? Or maybe because of your real estate background, it was an easier transition for you because it really is based off the asset? Is there anything that really kind of comes to mind that you thought of that really concerned you at the beginning?
Absolutely. The first thing that came to mind is this is too good to be true. Because
Yeah.
I mean, I was when we were talking about the yields and everything else, I'm like, wait a second, wait. You mean to tell me I'm gonna get a wire or check every month for this amount of money and I'm gonna do nothing? Yeah. Well, I'm like, well, every time I've got myself in that situation where it's too good to be true, it's too good to be true.
Yeah.
So I was very, very cautious because I've been through in some bad situations with people that are very close to me that have whether it's a Ponzi scheme or clients that I've lent money to or partnered with, very cautious um, that it was all too good to be true. So that was, I mean, the biggest thing that came to mind was, wait, is this real? And fortunately for me, having the individual that helped me out in the business had been around a long time, really trustworthy. I knew the one who introduced me to him. I've known him forever, and he's like, oh yeah, this guy, he's not going to get himself into a bind. So, but you're still like, wait, this doesn't make any sense at all. And even to this day, I have so many people ask me what I'm doing now with my life, and you know, sometimes I feel like I shouldn't tell them because they're like, "Well, can we get involved? Can we do that?" But it's you got to understand there is still risk to what we do every
Yeah.
day. Not every deal is gonna be a success.
Yeah, no, I agree with you. And I mean, you kind of hit on some of the resources that you used when you first got into this industry and were trying to educate yourself. I think referrals are a great source of a resource. I mean, there's no better way to learn from other people's mistakes and their experiences. There's also a lot of online resources. I don't know if you use any of those. I do know that you use a lot of, like, when you're looking at notes, you need to do your own homework. Like, it's great that you could potentially buy a note from Central Lending and we're going to give you this full due diligence package, but I tell people all the time, do your own push-ups. Like, this is your money and you have an obligation to your capital and your family to do your own due diligence. I think there's a ton of online resources. One of the big things Jamie and I look a lot at is when we're looking at these deals is the value of the property, because the risk is somebody doesn't pay you, you might foreclose and you're going to own that property. So you better be darn sure you're comfortable with the value that they're saying it's worth, with taking it back. I know that I use Zillow a lot just to kind of evaluate, and it's not the gospel by any means, but I think it gives you a really good idea of what that property's worth and the surrounding properties. Are there any other online resources you weigh pretty heavily on? I know you use some other ones, but anything worth mentioning?
Well, one of the best things I did about 2 years ago, I basically worked with an asset manager on a national level. And what he does is before I buy a note, for the most part, depending on what it is, I'll run the deal by Bob, and what he'll do is call a local realtor in the market, because the appraisals are all fine, but that's like objective. To me, the people that are going to put the best value on a property is a broker in the market that's selling those
Yeah.
assets. So, that's, I'll look at what's on the market, what recently sold. But now to save time, I've engaged with an asset manager. I also have an attorney that handles all my like if there's a foreclosure or paperwork on a national level. He kind of takes care of everything for me. I've tried to streamline the approach and make things simple, delegate. Maybe costs a little bit more money than I should spend, but it's peace of mind. And it's I don't want to get stuck doing all this. It's not a lot of work, but you want to do things the right way to take care of things as quickly as possible and eliminate the problems.
Yeah, I think that's great advice. Um, do you remember the first note you bought?
Yeah, it was a house in Florida, and I'll never forget it because it was the reason why um I decided the reason why I decided to do this at the end of the day was, and some people are like, you're crazy. Real estate changed my life. Commercial real estate allowed me to do things, put me in a position I'm in today to be able to do this, to be able to live the life that we live. And I wanted to give back. And I know there's people out there, and I talk to them every day, that whether they want to buy a home or they want to try to, create more equity for themselves, they can't get financing for whatever reason, or it takes
Mhm.
them too long, or they ask for their blood samples and their firstborn. I wanted to make a difference. And on the first deal, I'll never forget, the borrower was ready to sign the deed over to me. It was like a $200,000 note, and the deal was worth like 400,000. And she had so much equity in the deal, and she was ready to sign. I said, no, 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 don't do it. And everyone's like, you're crazy. What are you doing? I said, you know what? No, I don't feel good about this. I said, you know what? All you need to do is this, 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 and you will sell the property. And she did that. And she ended up making whatever it was, a lot of money. And she wrote me a note and called me after and said, thank you so much. That changed our lives.
Wow.
And that was, the big thing for me. And, you know, it wasn't a textbook deal where I think I got like three payments and then things really slowed down. But it was good that I started off that way and kind of was able to see, some of the kind of the negatives and how to work through them. So I'll never forget that. I don't know if she bought another deal, but she didn't do her due diligence on the front end, and
Mhm.
she got into a program where, it was a teaching program. But they didn't teach her how to sell the asset. And I actually helped her sell it, but just the pictures and the marketing, she had
Yeah.
no idea. So I was glad to, at the end of the day, it made me feel good about what I was doing, and makes it all worth it at the end when you have people like that and that say thank you at the end. That
Yeah.
was, important.
It's nice to be appreciated. And, I do think people, especially with private money notes and people that are fixing and flipping, there's a lot of different notes out there you can buy. You can buy owner occupied, you can buy car notes, you can buy, what Jamie and I are mostly involved with is private money lending to real estate investors. So they're not supposed to be living in the property. I mean, that is a risk. They can move in it. But I think people get in over their head. I mean, I am personally doing one right now, and I haven't pulled the trigger yet because I'm like, this is scary. It's a ground up construction, and you want to run your numbers 10 different times to make sure you're in it the right way. And I think people get in these programs, or they're on TV watching Chip and Joanna, and they think it's going to be glamorous, and it just is not. So it's nice to know that there are lenders out there like you that are willing to help the borrower be successful, because that is not always the case. I mean, there are some lenders, the key to private lending is you're lending with equity, right? You're not typically lending more than 70% of the value. So there's really two components, and maybe this might make sense to talk about. This is like, and every lender has different things that they look for. Some lenders are really honed in on the borrower. Are they a good borrower? Do they have strong credit? Do they have money? Some are only concerned with the property, because they're more of a loan to own lender, where they're like, listen, I don't really care about the borrower. I hope they don't ever make a payment to me because I'm only lending them 50% of the value. I'm going to foreclose. That is not Jamie. But are there any things that, when you're looking at, and we're still talking mainly about the notes, are there things that you look for in those deals specifically that are more important to you than others? Or is it, I actually call it storybook lending.
Yeah, so I'd say over the last 2 years, I've really taken that box and closed it in, because I try to limit the amount of problems. Like, I don't want to take chances anymore on deals and
Yeah.
chase people down. So, my big thing right now is skin in the game. The amount of money that the borrower's actually putting in the deal themselves, not a gift, not another investor. What are they actually putting in the deal? And that's one of the things, Heather and Andrew do a very good job of, assessing and making sure, qualifying that these investors are actually putting their cash in the deal. And it's the skin in the game. I also look at the track record, and probably one of the most important things is, at the end of the day, it's the asset, it's the real estate.
Yeah.
Because if you got to always, I hate to say this, but you got to always plan for the worst. Well, if I
Mhm.
take this back, what am I getting back? Now, with that, it's also important to, you want to also make sure the key components of the house, the roof, the HVAC, the structure, looking at the budgets, and make sure that if those items aren't getting touched, what is the condition? Because if you do take the house back, like when I first started, I took homes back and I had to put new roofs on, new HVAC. The structure, the foundation was an issue. And that stuff, sometimes just gets overlooked. And again, that's part of the due diligence as a lender that you need to do up front on these deals. So, it's kind of the skin in the game. The investment is the biggest thing,
Yeah.
because you think about it, that this is their hard-earned money. Are they really going to walk away from $20,000? And that's what I always think about at the end of the day. Okay, here's their investment. Are they really going to walk from that much money? What is their, do they own a house?
Yeah.
What's their occupation? Are they hiring a contractor? And these are things you'll learn over. It doesn't, on the first deal, you don't know all these things. It's over time. And it's working with a company that is there to assist along the way, and isn't just there to sell you a note and on to the next one, on to the next one. So, and that's been the beauty of central lending. I mean, I've, um, how I found Andrew. I mean, this is, you talked about how I, you know, use resources. So when I got started, the individual said, here's three companies. And I said, well, how am I going to find more? I need to find more people. And I went on the internet and I just found like a list of companies, and I just started emailing the principals. Do you sell notes? Do you sell notes? Do you sell notes? Andrew was out of like the first 10, Andrew was the first one that responded. We talked for like 3 or 4 months, and he's like almost talking me out of it because I was probably one of his first to buy individual notes.
Yeah.
And we did our first deal, and we talked all the time, and then we did our second, our third, our fourth, and then things just really took off from there. And it's been, for me, it's been exciting because I've seen the company from, one, two people, three people, to some people in the background, to where they are now. With I've been to the office in Lakeland. I've met the staff. I mean, it's unbelievable, the growth, and the growth in the right way.
Yeah.
You guys are doing business the right way, and not just setting up people to fail. You're setting up people to be successful as long as they follow the key principles.
Yeah, yeah. I would agree with you. I think the things that you look for in a deal, and I think the things that you look for change over time. When you
Absolutely.
have a bad experience and you're like, "Oh, we really thought that guy was gonna perform and he didn't," and then you start looking deeper into deals. But I would agree with you that skin in the game for me is huge. 100% funding. I mean, I've been involved in millions of these deals, and I will tell you the bulk of them that go sideways are people that do not have skin in the game. They don't have cash into the deal. They don't have a vested interest, and so what tends to happen, they have an issue, a contractor takes off on them, a tenant moves out, and they just have nothing to lose. And they finally get so frustrated that many times they will just walk away from the project. I think also aligning yourself, if it is a rehab loan, which is probably the riskiest deal you can do, right? You're relying on this borrower to get the project done. My suggestion would be do not front costs for any rehab things. It should be a reimbursement style rehab draw schedule, meaning that they should go get the work done, they should pay the contractor, and then you're sending out a third party, which is what central lending does. We send out a third party to make sure the work has been done. That way you're controlling those rehab funds. The worst thing you could do is give them a loan to rehab a property, give them all the rehab funds, and good luck getting them to actually finish it. They may take that money, spend it on another project, they may go on a vacation, you just don't know. So I think making sure that either you're managing that or the operator that you're buying the note from, like central lending, is managing that. We have a actual department that manages rehab draws. It's a lot, and it really is important to make sure that that's being done, because the ones that I also see a lot of issues with are the ones that haven't taken a draw for 6 months and nobody's called them. Like, hey, you got this loan 6 months ago, you've got $100,000 sitting in a trust account and you're paying interest on it, but you haven't taken any draws. Those are typically red flags that something's not right, or they take half of their budget and then we don't hear from them for 4 months. You need to either be doing that yourself, calling them up, making sure they're on track, or aligning yourself with an operator like us that's making sure that that's getting done. It doesn't mean that it can't go sideways and there's not risk, but is the quicker you can identify red flags that a account's having problems, I think the quicker you can find a solution.
And a couple things to add on that too is like one of the things like that's really hit hard to or hit home now is the judicial versus non-judicial states. I foreclosed on two homes in Philadelphia 14 months ago, and I just got one sheriff's deed last week, and I'm still waiting for another. So that's a year where I've been fighting to get the deeds to the house, where I've had to pay the insurance. I haven't gotten any income. Actually, the old borrower is running a hotel now, and he's collecting all the income because he can, and I can't get them out of there soon enough. So the
Yeah.
judicial versus non-judicial is a big thing. And also, like, as hands off as this is, you have to be hands on. Like, I'm like a control freak with this. I have a spreadsheet that I keep of all my notes, all my funds that I look at every morning. And Heather made a great point. Like I know when that they've taken a draw, and if there's a deal where they haven't taken a draw in 30 days, I reach out to central servicing. I said, hey, what's going on with this? Please get me an update on where we're at. You got to stay on top of this stuff, because if you don't, you're waiting for a problem to happen versus getting ahead of it and knowing if a problem's gonna is in the horizon. So
Yeah. Yeah, you always know where your notes are. I've got a handful of investors that have the kind of volume in notes that you do, but regardless of whether you buy one from central lending and we're helping you with it, you have to know what's going on with them and you have to keep track of them. Relying on a servicing company to do that is unrealistic in my opinion. What a servicing company is going to do for you when that borrower does make their payment, they'll apply it properly most of the time, and they're going to disperse the interest payment to you. And then at the end of the year, they're going to do the tax reporting. They're going to let you know what you received in interest. They're going to let the borrower know what they paid. But other than that, they are not very hands-on with collections. They're not going to make sure people are getting their rehab project done. And it's funny that you say Andrew kind of tried to talk you out of notes. I do the same. Like people need to understand there's a lot of opportunity buying notes, and it's a great way to deploy capital and get a really good return on your money. But it doesn't not come with risk. And, so I would rather be transparent up front from the beginning. Like these are the things that could happen. Your borrower might not pay their insurance. Well, I'm going to be calling Jamie saying, hey, good news is we put them on forced place insurance. Bad news is we need you to pay for it. So as long as you know going into notes, I think there's good opportunity. I will mention one other downside, and I know that you struggle with this, is your capital being undeployed. So what I mean by that is you've got $100,000 note in your IRA and it only went 90 days and that guy paid you off. And now you got to find another home for it because Jamie's very good about keeping his money out there working all the time, which most of our investors are of the same opinion. But there could be a period of time where we don't have another note for you and you got to wait and not get so anxious. You actually kind of hit on this at the beginning of this webinar, is that don't be so anxious just to get your money out there and work. Make sure it's the right deal. But there is that downside to undeployed capital and waiting for the right deal to come along.
yeah, I mean that's as important as it is. The key thing, like what you said, don't rush to get money out. That was the biggest mistake I made when I first got into private capital. Is I
Yeah.
was in such a hurry to get the money out there that I couldn't do it fast enough, and that's what led to a lot of issues. And it wasn't just about the yield; it was just the quality of the deals, the due diligence. I just didn't do the fundamental due diligence on the properties, whether it was the assets, the borrowers, the budgets. You owe it. This is hard-earned money, and give yourself the day, the two or three, whatever it is, to make sure you get all your questions answered. The other thing too is if you ask a question, if you don't get a response in call it 2, 3, 4 hours, that's almost a red flag for me, because they're searching for answers. So it's the response to the questions you have that also kind of leads me to, okay, is this going to be a problem or is this not going to be a problem?
Yeah. Yeah. And it circles back to keeping track of your notes and what's going on with them. And if you are aligning yourself and buying notes from someone like Central Lending, they should be doing that for you. Or you just have to realize that's something you're going to have to do yourself. So this kind of segues into the funds. So when Jamie and I first met, I think all you ever did was notes.
Yep.
And the other thing is working with someone like Central Lending or having a good pulse on what's going on with your notes. You should know when you're getting paid off because you should be having to approve payoff quotes, which is a little bit of a thorn in Jamie's side because just because you approve a payoff quote doesn't mean they actually pay off. Sometimes they're just trying to find out how much they owe. Sometimes they're refinancing and it gets delayed. But regardless, if they're asking for a payoff from the servicing company, it's typically a good indicator that they're getting ready to pay off. If you're doing that and you're monitoring your notes, then you're going to know, hey, I'm probably getting paid off on this. And Jamie's great about texting me, hey, I think I've got X amount of dollars coming in. Let's start finding another deal. So the name of the game is like get paid off, which is great. You want them to return your capital, but get it redeployed as quick as possible too. So, that kind of goes back to Jamie being on top of his portfolio. But with some of these pros and cons with notes, I know that you have started transitioning over to funds, which was not the case when we first met 4 years ago. So tell me a little bit about that and kind of what was the motivating factor to start considering putting money in a more of a fund environment?
Well, the number one reason was diversification. I needed to diversify. It's so much money in individual notes, and some things have changed in my life as far as I now represent a large restaurant franchisee and all the real estate. So, that started taking more and more time. And then my commercial properties that I own, along with a couple families that I do consulting for, started taking more time. So I sat down with Heather and I said, okay, like, here's what I'm looking at. Like, let's strategize here. Let's, what should I be looking at? And we looked at different options, and I said, okay, I think I need to start deploying into some funds. And what I did through Central, I'm in a few of their funds, and then I'm in also some outside funds, some same thing, real estate notes. Right now I think it's like it's 60% funds, 40% notes. Depending on how busy I am, I that'll tend to fluctuate. But it's a good mix of so what I do now is I see when I have money coming in. So the note money is almost, nothing's guaranteed, but I know that comes in almost the same day every month. It's going to be the same amount, and that's more kind of my coupon clipper. Don't worry about this or that. Whereas the note money, for the most part, it's mailbox money, but you just never know with it. And with the notes, you run the risk of the payoffs.
Yeah.
Whereas the funds, that's out there as really as long as you want it to be. So, that's when I look at my portfolio and the balance, I feel like, depending on what's going on with my life with travel, like over the summer, like I don't want to have to deal with buying a lot of notes. So
Yeah.
I'll put the money in the fund. And then if I have more downtime, I'll pull the money out of the fund. But, it depends, where people are with their life, but the diversification is great so that you don't have to, the funds are great because you just don't worry about it. And on some of these funds, the yields are very close to the
I
yields on
know.
individual notes. I mean, it's gotten a lot closer. Um, so it's having a good mix of both. I think is the key to success.
Yeah. 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 And to that point, I think years ago, the returns were higher on notes.
Mhm.
I remember selling notes at a pass-through rate of 13, 14%. We were originating notes at 15 and 16. One of the things I can say about central lending that I just really appreciate and enjoy this environment is we really aren't out to attract the guy that's willing to pay 15% right now. There are so many lenders in this space, and it's a very competitive space to originate paper. Um, the bulk of the notes that we sell go to Wall Street capital providers. And because of that reason, we write to their guidelines. So the quality of the paper that central lending writes is very conservative in comparison to the private money industry. Which means, if we're only writing it at 11%, our pass-through rate's 10. We're originating through the fund, we're arbitraging it, we're keeping an interest strip and selling it off so we can recoup the capital and redeploy it. So to your point, like years ago, I remember my note guys, on average, were getting 13% on their portfolio. That is not the case anymore. I'm sure there's those notes out there. They're just not going to be the same quality. So, why give yourself brain damage trying to find a note, making sure it pays, having the stress if it doesn't pay versus just throwing it in the fund? You might take your $100,000, buy one note, that guy doesn't pay. Now your cash flow is affected. Jamie typically invests in these alternative investments to create cash flow for his family. Your cash flow is now affected where you can take that 100 grand, put it in a fund. It's diversified over 300 assets. One of them doesn't pay, and you don't really see the ripple effect from that, right? So I do think this whole industry has changed over the years. And I think, to your point, like, note buying is not passive. If you're doing
No.
it right. If you're
Yeah.
doing it right. You could be passive. I don't know how well your portfolio is going to perform if you're not involved in it. But if you're truly looking for an asset class that's passive, a debt fund is a great option. That's what we have. So we basically, our fund is all of these notes inside of it. You get to either share as an equity member or as what we call a fixed rate offering, where you can basically pick the term of your note, how much you invest, and how long you tie up your capital dictates what your return is. And talk a little bit about, I know that mostly what you do with me is more around the cash flow strategy. Are you doing any alternative investing where it's more long-term growth minded, or is everything really more focused around cash flow?
So I look at my investments as the different buckets, and I think I touched on this before. So as far as this, like this particular bucket is my monthly cash flow. This is what supports my family right now. This is what's paying the bills. This is a big part of my income is the cash flow this is generating. My the stock money, um, I don't even look at that. I talk to it's a buddy of mine I've known forever that's super conservative. Um, I talk to him once every few weeks just to get an update. But I kind of leave that's the passive. I really don't mess with that at all. And this is the cash flow. This is really what's supporting the family right now. And this does provide, whether it's via funds or notes, you can make very good money off of doing this strategy, along with having other strategies. I would not make this your only investment strategy.
Yeah.
The diversification I can't stress enough, whether it's your residence. I also own 8 commercial properties, so my cash flow from that is it's from all different avenues. And I've always said, hey, if things change on the commercial side, I'll start pulling more out of notes. I've been saying that for 5 years, and that hasn't been the case. So going forward, what's great about this business is you could number one, you can do it anywhere. It's you don't need to be in an office all day, and it's all who you associate with. As long as you associate with good quality people, you're gonna do well. And as long as you don't chase the yield, you're gonna do well. And that's like with the 15%, like so if I see a deal like anything north of 13%, I'm like, what's the problem with it?
Yeah.
I had one, it was like I remember seeing one, it was a few months ago at 17%. I'm like, what's the problem with this? And the borrower had just gotten acquitted from a murder charge.
Oh, God.
And yeah, and I'm like, and here's the thing is like I was like I almost was gonna do it because I felt bad, and then I'm like, no, 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 no. Then I saw Heather popped up on the side of my head. She's like, "You're crazy. You're not doing this." And I didn't do it, and because every time I try to go outside that box, it always is an issue, and you're better off just staying in your lane. And you look at it, okay, the difference between that return and what you're earning now, it's a few $100s a month, and for the aggravation and brain damage, it's just not worth it.
Not worth it. So how is, like, you can just give me percentages, like your total portfolio right now to include your traditional stuff. If you had a pie chart, what would that look like?
I would say 50% is I would say like 40% is stock market. 40% is going to be this private capital, and then 20% is going to be my commercial real estate.
Okay. And of that 40%, you have about 60 in funds and 40% in notes right now.
Yeah, and it just fluctuates given
Yeah.
and also given the opportunities. Like if we're in a lull where there's not a lot of individual notes out there, we'll sit and say, okay, let's like put it in this fund and see if anything changes.
Yeah. I mean, you
Um,
and I talk almost daily about
yeah.
that stuff. So,
And again, you have to be ahead of this stuff. You really need to be proactive with it, because the more you're in front of it, the better you'll do. And it's, I mean, it's been a great alternative investment strategy. When I talk to friends and family about it, they scratch their heads and almost wish I didn't say anything anymore, because now I have friends and family that call me up saying, "Hey, would you do this loan?" I'm like, "No, I don't do friends and family loans."
yeah. Yeah. Once word gets out, it
Yeah.
spreads pretty quick. So, if you were going to give somebody brand new to this two bits of advice, what would those two be?
Take your time. Patience is the key thing. Flexibility is also important. And then the other thing that is, that I look at is like what I expect from my borrowers or people that I work with. My biggest thing is integrity.
Yeah.
You better do what you say you're going to do, because that's the biggest thing for me with whether it's a borrower or any of the companies. Integrity and communication. And I tell the borrowers this all the time. Even though we're it's good to have the middle person in between and not talk to the borrowers. But what I try to do is when I talk to servicing with Central, I said, listen, here's the deal. As long as the borrower shows integrity and communicates, I will work with them all day
Yeah.
long, because I don't want to foreclose. I didn't get into this business to foreclose on these assets. I got in this business to help people, but they need to show integrity and they need to communicate. The second that they don't do what they say they're going to do, the second they don't communicate, all bets are off. And I'm not going to, I'm relentless. And, that's why, I've surrounded myself with the attorney, the asset manager. So if I need to, we can move quickly on these things. But as long as you do those things, I mean, I mean, I've done things that the Central said, don't do that. And I said, well, what, let's do this, because it's the path of least resistance. I know it's not the right thing, but at the
Right.
end of the day, it's gonna, hopefully it'll get the deal done.
Well, and you've been able to resolve some problems. I don't advise this calling borrowers, but I know that you actually, Jamie doesn't listen to me sometimes.
It's not a good
But
quality, man.
but to your credit, like I think sometimes these borrowers think these are big, multi-million billion dollar capital providers that are lending them money. They don't realize that there is a real person on the other end of this that's worked very hard to have the capital they have and are lending the money out. And I think sometimes having that connection with a borrower has helped you resolve some problems, versus them thinking it's some big bank and, oh, what do they care if they foreclose on this one deal of mine? I don't think a lot of times borrowers and brokers realize there's real people on the other end of this.
With that said, though, there is, like, you got to be very careful,
Yeah.
because um, once you cross that line, it's because then what they do is they will contact you all the time.
Yep.
So, I do make it known to them, hey, listen, you know what, here's the key principles that I look for. If you do this and this, I'll work with you. But if you don't do this, like, this is my life. I've worked very hard for this money, and I'm not at a point where I'm going to go out and make it back again. So if you screw with me, I'm going to come for your throat
Yeah.
and
And you have to be
set the
prepared
tone.
to
Yeah,
do what you say you're going to do, because the ones you give grace and
yeah,
lenience to tend to take advantage of your kindness.
yeah, and like it's. I mean, the good thing right now is with any of these borrowers. With the internet and social media, you Google someone and you can find out so much about them. With that said, like that's really where Andrew and Heather excel, is to find. I've never seen a company find things about people like that. I'm like, how did you figure that out? And it's, oh, we have the service through a rental car company, blah 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 blah. Like I used to be the when in commercial real estate, I used to find people's numbers that no one else could find,
Yeah.
and that like um that's the beauty is that everyone goes above and beyond, and they're going to push the envelope to find every bit of information to protect us as investors and them as a company. So that's really important to note.
Yeah. Some of it's a gut check. We found one today in underwriting that the original borrower got foreclosed on by one of our capital providers. And now they have the wife trying to buy the property back. And Andrew caught it on the title who the original lender was, which was one of our capital providers. And so they thought by putting the wife's name on it and creating a new LLC, we wouldn't, they were basically trying to buy the property back that they just got foreclosed on.
Wow.
And
Well, but
Andrew's like,
that's
I recognize this.
yeah.
So yeah, I mean, some of it's going with your gut, if things don't add up or it's too good to be true, it probably is, but I think aligning yourselves with people like Jamie, companies like Central Lending, it's not that there's not risk in any of it, but the more due diligence you can do to protect your capital, the better off you'll be. And my advice, at least notes versus the funds. I've had a lot of people lately ask me, well, why would somebody buy a note versus going into the fund? I mean, I think if you're more hands-on, if it's in your backyard or it's in a market that you're very comfortable with, I've had note buyers say, my Aunt Sally lives there. I love that area. Then I think a note is a great option as long as you know going into buying a note some of the things that can happen and the risk in it versus going into a fund environment anymore. You can get the same kind of returns with a lot less headache, providing it's a fund that's being properly managed by a company that has a track record, that's auditing their fund. I've heard horror stories of people investing in funds that they didn't do their due diligence. You're not as liquid going into a fund. You're really relying on that operator, Central Lending, to do their job and manage it properly. So, again, it goes back to due diligence.
Well, and it's funny. So there was a fund that I was in up until 60 days ago in Las Vegas, and I was in the fund for 3 years, and I had bought notes from them. And I asked them, I had never asked them this before, but something was bothering me. My gut was telling me something was not right with them. And I said, "Hey, is your fund audited?" And they're like, "No." I said, "Well, can I get an update on how many notes you have out there, the performance?" And they dragged their feet, and then they came to me and said, "No one's ever asked us for this." I said, "You know what? You have a significant amount of my money, and as an investor, this is stuff that I'm privy to, and if you don't want to give it to me, that's fine. But consider this, me calling my money in the fund due." And I emailed them after, and I called the money due, and I got it out of there. Transparency is so important.
Yeah.
And I want to make this clear. Central isn't paying me to do this. Yeah, Heather and I are good friends, and Andrew's a great guy, this and that. But this company does go above and beyond the layer of servicing that they basically service the servicers,
Yeah.
and you don't find that in the industry. The other thing too that's real important is, if you're new to the industry and you're looking to get started, ask to speak to other investors that have worked with the company for
Yeah.
a
That's
long
a good
period of
one.
time, different that are a year in, 2 years in, 3 years in, because this is your hard-earned money. You got to do the due diligence. You owe it to yourself. But I guarantee it though, with Central, that it's the percentage, the foreclosure rate that I've dealt with is the lowest that I've dealt with in the industry. Have I lost some money? Yes. You're gonna lose some money. Nothing's ever perfect. You're not gonna bat 1,000, but they're gonna do everything they can to help protect your money and guide you in the right direction. So, but talking to other lenders that have bought notes or in the fund is very good. The other thing, notes versus the funds, like the way I look at it, the reason why I have the balance, sometimes I need money to pay my taxes. So what I'll do is I'll sell a note, will sell, and I'll take that money to pay my taxes. Sometimes I need to pay for someone's whatever it is, and at least I have that liquidity coming in from the sale of the notes.
Yeah.
So with the funds, that's kind of longer term. So you want to ask, well, what's it cost me to get the money out? How long does it take? That's why I keep the balance the way I do amongst the funds and the notes. I want to maintain my
Yeah.
liquidity, but I also want to know that the money's deployed and I don't have to redeploy it every 3 months.
Yeah, that's a really good point. I mean, our fund has a pretty short tie-up period, which is 12 months, which in the industry is pretty insignificant. But to your point, like you have life events that come up, and once you're in for 12 months. You're not getting your capital out, which still isn't that long. But if you've got a kid's wedding or college to pay for, or home improvements, that's probably not a good strategy. Where the funds, you could stagger them. You could find 6 months notes, 12-month notes. You could kind of have a diversification in there. I do want to encourage people that are on here live streaming and on the webinar link. If you guys have questions for me or Jamie, we'll stick around here for a few more minutes. We're kind of getting to the top of the hour, and I want to be just considerate of Jamie's time as well as your guys's, because I know not everybody's in the Pacific Standard Time like I am. It's only almost 4 here. But if you guys have questions, please put those in through the comments, and we'll make sure and address those. We did have a nice comment from somebody that said, "Hey guys, thank you. We appreciate your company." Thank you. We appreciate our clients, borrowers, brokers, investors, fund members. I mean, we need everybody to make this business model work. And so we're very appreciative of everybody's business for sure. Let's see here. We covered a lot. We could probably talk for hours. I feel like you and I, Jamie.
Absolutely.
I am going to put this up. So a couple things. As far as the notes go, if you really truly have interest in the notes, we do market the notes with a email that we send out 2 to 3 times a week. So we'll send this email out. I'm going to put a QR code up there. We call it our note blast. Cade, that works very closely with me, actually sends this out. And these are our latest and greatest notes that we have available. If you see one that you have interest in, or you want to get on that list, download this QR code. You can give us your contact information. We're not going to sell your contact information or spam you. But once you see those offerings come out, you can ask for more information. You get what's called a due diligence package. That's what Jamie uses to do his due diligence on these deals. And you get to see everything. You get to see everything about the borrower, who they are, what their story is, what the property condition is, what they're going to do to it. If they're going to rehab it, we'll have a rehab budget in there. But that's the due diligence package. So if you want to get on that list, that QR code I have up there right now is going to take you to give us your contact info. You're always welcome to reach out to us at Central Lending. Go to centrallendingcapital.com, and you can get more information about our funds. You can contact myself or Cade and schedule a time that we can talk more about you. But just super thankful, one, for your friendship, Jamie, and your continued support, and for you taking the time out of your evening with your family.
Oh, you're welcome. It's always a pleasure to talk to you, and I'm very thankful of everything that Central's done for me over the years. The entire team, they go above and beyond for me, myself, my family. So thank you guys. I appreciate it.